Hi everyone, my name is Jonathan Lesser. I'm the Director of Investments at EquityMultiple. Today I'm joined by Jonathan Jaeger, who's a Managing Director at LW Hospitality Advisors, a New York-based hospitality advisory firm. John is going to talk with us today about investing for individual investors in hotel properties and what that means for EquityMultiple investors. So with that, John, I know we used to work together, but it would be great to have you give an overview of yourself, your background, and LWHA.
Absolutely. Well, thank you for inviting me here to speak today. Always good to see you, even though you left the company. But LW Hospitality Advisors is a full-service hotel consulting and advisory company. Started in 2011, so we're about 7.5 years old. So in those years, we've done work in all 50 states, Canada, Mexico, and the Caribbean. Primarily, we're doing market studies, feasibility studies, all for hotels, valuations and appraisals. We also asset manage hotels, basically representing owners on behalf of and overseeing the management companies that actually manage the hotels. We do impact studies for brands. We help clients, private equity primarily, with underwriting and due diligence when they're looking at acquisitions or potential repositionings. So really full spectrum, anything hotel real estate related. Across the country, again, Canada, Mexico, Caribbean as well.
Suffice to say, you guys are the hotel experts.
I'd like to think that, yes. Yeah, absolutely.
So with that, for individual investors, such as a lot of the folks on the EquityMultiple platform, hospitality can be a little daunting. A lot of folks are skeptical of an oncoming sort of downturn in the economy, as well as the rising interest rate environment. So can you give everybody a quick overview of the national lodging market as it stands today?
Absolutely, and this is a topic I could speak about for hours, so feel free to cut me off at any moment. But we're at a very interesting point right now in the national lodging industry. 2009 was by far the worst recession the industry's ever seen. National RevPAR had declined about 16 or 17%. Since then, so starting in 2010 till today, and sitting here in July of 2018, we've been in a upmarket cycle. So we've seen month-over-month increases in supply, demand, occupancy, ADR, which is average daily rate, and then RevPAR, revenue per available room, for over 8 years, which is unprecedented. Usually the cycle in the industry is, call it 6 to 7 years, depending. And so we saw basically what's happening with metrics is occupancies have reached peak levels and have sort of leveled out. Average rates are continuing to tick up, not as strong as they did in 2010, 11, 12, but now more like 2 to 3% is kind of the estimates that we're seeing for the last few years. Everyone or some people are negative on the industry, but the metrics are still strong and we're seeing increases, just not 5, 6, 7% increases like we did a couple of years ago. It's more 2 to 3% increases. But the most important thing I would say, at least for the work that we do, is those are national statistics. When you're looking at a hotel investment, it's very important to look at that particular submarket and competitive set for that hotel. So for example, last year, national RevPAR increased about 3%, but some markets were down 10%, some markets were up 10%. So it really varies by submarket and by specific demand generator.
Right, that makes sense. But at the high level, do you believe that ADR is really what's going to drive RevPAR and as such, top-line revenue for hotels going forward?
Absolutely, absolutely. I think because of a couple of reasons. Seasonality is one. You have a lot of markets in the Northeast that are seasonal and are pretty much sold out during the peak months, so there's really no room to grow there in occupancy. And with new supply coming online as well, that is bringing occupancy rates not down, but limiting the growth. So it's really revenue and ADR rate that's going to grow.
Sure, that makes sense. And we actually recently went to market with a limited service Fairfield Inn property in a tertiary market in Illinois. So you mentioned that it's very important to look at the hotel's competitive set and the demand generators in the market. So can you talk a little bit about how the national trends are going to affect sort of hotel performance in secondary and tertiary markets?
Absolutely. I think it's important to look at national trends as a guide. But then you mentioned Rockford, Illinois. looking at what's going on in that market. So in that market, one of the major employers is Chrysler. And so in 2017, Chrysler did a major retooling of their plant there, and they were building Jeep Cherokees. So it brought a lot of new demand, not just from Chrysler, but think about all the support companies, whether it's tires, engines, I mean, anything. I'm not a car expert, so I don't know what else goes into a car. But that brings demand, brings people into that area. So that really helped the market. In addition, there's healthcare is a big sector there. Mercy Health is building a new hospital. It's very centrally located. It's about 85 miles northwest of Chicago. Easy access to Wisconsin and other states throughout the Midwest. And so it's become sort of a regional hub for healthcare in that Northwest Illinois corridor as well. So again, looking at the national trends, but then what's going on in Rockford and knowing kind of what the impact might be going forward.
Sure. That makes a lot of sense. And when we were underwriting the Rockford deal as well as other hotel investment opportunities, we really have found that the stabilized, cash flowing, limited service product in markets where there's strong demand generators, we feel as if that product is actually the most compelling investment for individual investors such as EquityMultiple investors. What do you think about that notion? Is that right? Do you think that there are other asset profiles that we should be underwriting?
Mm-hmm. No, I would agree. I think what we saw during the last downturn, which I think is the best example to use here, is when you have full service hotels, 200-300 room hotels or more with substantial amount of meeting space, food and beverage facilities, you're talking a lot more fixed costs, whether it's on the utility side or really labor, which is by far the biggest expense for a hotel. Mm-hmm. Whereas at a limited service hotel, you're usually 100 to 120 keys on average. But the staff that you need to operate that hotel is much smaller because usually your food and beverage is limited to just a free breakfast. So you really only need 1 to 2 people per day to prepare and serve and then clean up the breakfast. Obviously you need room attendants, you need maintenance and engineering and front desk staff and management. But it's relatively, I don't want to say simple because hospitality is very complex, but it's a much more straightforward operation, which is less people, less overhead. So when a downturn hits and your revenues fall, you could flex your labor and flex your expenses much better than you can at a full service hotel. So as far as protecting your downside, I think the limited service hotel sector has really blossomed to counteract that.
I think that's interesting. So that in an event of sort of a down cycle, you can adjust your expenses in a limited service property such that investors are still able to earn some cash yield and then ultimately hold until the economy comes back and then sell, exit.
Absolutely.
Got it. Yeah. So let's talk a little bit about brands.
Okay.
As you know, we recently went to market with a Fairfield Inn property. Mm-hmm. Can you talk about that brand specifically? And obviously that's in the Marriott family of brands. Mm-hmm. There was the large Marriott Starwood merger recently. Mm-hmm. Interested to know how that's affected brands generally as well as the perception of Fairfield.
Absolutely. So Marriott, as you know, is now 30 brands once they took over Starwood, which is far and above any of the other chains that are out there. Worldwide, Marriott's got about 6,500 hotels. Fairfield Inn represents 935, I believe, last I checked, of those. So that's about 14-15% of all Marriott hotels when it's one of 30 brands. So I think that says a lot about the way the brand has sort of morphed into a brand that can fit in more locations than some of the more upscale and luxury brands. So we see a lot of Fairfields throughout the country being one of the upper, in terms of the Marriott family, it's known as an upper mid-scale brand. Mm-hmm. Limited service brand, like we were just talking about. And it's, I think it's one of the more popular brands for what we call the road warriors in the industry. People that are on the road traveling, maybe half the year. It's a quick in and out, usually suburban locations, free parking, free breakfast, free Wi-Fi. So it's definitely, a very successful Marriott brand.
Great. That's good to know. So just to wrap up, Can you give maybe a little bit of an overview as to what sort of diligence equity multiple investors should be considering honing in on when they're evaluating hotel opportunities?
Absolutely, and so this is what we would tell to our clients, when they come to us to help them underwrite an investment opportunity. Is I kind of look at it in two different spectrums. One is the market. So we talked a little bit about looking at the demand generators, the supply. Are there any new hotels being built? So for example, in Rockford, it'd be trying to get a handle on Chrysler and what their future demand or future outlook in that Rockford market would look like. On the supply side, is there a new hotel being built? If there is, what type of competition will it have on the subject property? So that's kind of the market. And then the actual physical asset. So you want to look at the condition and the quality. And I'd say one of probably the most important things that we see that'll impact a transaction is PIPs, what we call property improvement plans. Whenever a branded hotel is sold, the brand can come to you and say, if you want to keep it this brand, you have to complete this list of items. New bedding, new carpets, new wall vinyl, vanities in the bathrooms, whatever it might be. And so that could really impact pricing. So you want to really know physically what your hotel will need, not just right away, but over the next 10 to 15 years or whatever your hold period might be. And then you want to look at the financial performance of the hotel and how it's been performing historically. Going forward, if you think there's opportunities to improve, or maybe even you need more staffing or need more expenses, you want to analyze that compared to other similar properties around the country. I'd say that's kind of the main focus for underwriting a hotel.
Sure, definitely, great. Well, thank you, John. Really appreciate you joining us today, and thanks for coming in.
My pleasure, thank you.